Good morning and welcome this morning to Getting Started with Options. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. Joined out there in the chat by my good friend Michael Fairborn. He is a 20, going on 30 plus year veteran of the financial markets. I'm glad to have Mike there to help answer your questions along the way. Welcome to all of you. Today is lesson 5 of 12 in this Getting Started with Options series. And our focus is on the concept of buy right covered calls. We talked last week about the idea, the general concept of covered calls, owning an underlying stock and selling a call option against that ownership for the purpose of bringing in premium. Today's strategy, the buy right covered call, changes that up a little bit. The intent is that we don't really want to keep the stock. We buy the stock, sell the call option at the same time for the purpose of generating income and also being able to buy the stock at a little bit of a discount and take advantage of upward stock price movement. But it is very similar to a short to intermediate term swing trade in its intentions and its technical analysis setups. So I think you'll see that as we get into this discussion. So be active there in the chat. Feel free to ask those questions along the way if you're here in the live version. If you're watching the recorded version of this webcast, by all means, leave us a comment in the comment section, and Mike is there to help answer those questions along the way. So a couple of quick housekeeping items, though, we do need to take care of. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or solicitation of any security or strategy or account type or anything else. Remember that options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transaction. Now, selling an option creates an obligation. Selling an uncovered option involves potentially unlimited risk. So make sure that you understand that characteristic as you get into these types of covered call strategies. Covered call strategies provide downside protection only to the extent of the premiums received, and they limit profitability above the strike price of the call. So we're going to talk about that as we get into this discussion. So we're going to use some technical analysis in this discussion as well. Now, remember that having sold a call, we've created an obligation. There is, if it's an American style option, the possibility that that obligation could be required to be satisfied at any time, meaning we could be assigned that obligation at any time up to and including expiration. So that doesn't matter if you're in the money, at the money, out of the money. We'll talk through that as we get into this discussion as well. Also, remember, we're going to be using the Thinkorswim desktop software platform, specifically the Paper Money platform, the Paper Money version of that platform. It is not a guarantee of future success. It's a great learning environment, but it doesn't do certain things. So if all you do is practice covered calls in your Paper Money account, you will not see early assignment of a short option. If you're trading in your live account, that can and does happen. So be aware of that as you move your practice from paper trading to live trading. Also, it's important to remember that if you own the underlying stock and that stock goes to zero, that risk is from where you own the stock all the way to zero. So in a covered call strategy or a buy right covered call strategy, there is potentially more risk in the trade than just the risk of having the stock called away. The risk is in the ownership of the stock. All right. So remember that past performance of any security strategy doesn't guarantee future results or success. And we'll talk through a lot of these things as we get into the discussion. So a couple of quick ideas as we set this strategy up. And let me just kind of take you through where we are in the structure of this particular webcast series, Getting Started with Options. We talked about introduction to options and option Greeks. Then we did long calls. Then we did long puts. Last week we did covered calls. Today we're doing buy right covered calls. Next Tuesday, we're going to talk about short puts or cash secured put options, where we sell the put option to bring in premium in that case. Then we're going to go to short put verticals, short call verticals, and on through the rest of the discussion. So we are on lesson 5 of 12, buy right covered call. So we talked a little bit about what a buy right covered call is. We're going to define it a little more specifically. We're going to talk about entry signals, strike selection, expiration selection. We'll talk about trade management techniques and ideas. And I've got a couple of example trades that we'll walk through. So the buy right strategy is a strategy generally where a trader, because this is, I think, for many traders more of a trade than an investment. Like I said, this is very similar to an intermediate term or short term swing trade, more so than it is to a longer term trend trade that doesn't really have a finite or defined end date in mind. But it's a strategy where a trader buys the stock and at the same time sells a call option on that stock with the intent of having the shares called away. That's where we get to kind of the little bit of the difference between this and the majority of the covered call strategies that we've been talking about, where our intent is to hold on to the underlying stock and to continue to write calls against or sell calls against that stock and generate premium month after month after month, or expiration after expiration after expiration. So the timing is maybe the difference here in this particular case, right? So JDML asked the question here. Never fully understood the buy right strategy. Wouldn't buying the stock first and then selling a covered call after a move higher potentially provide more upside and better premium collection? Well, it would not necessarily change your upside. It might give you a little bit more premium, but the idea here is that we put it together, and you can do that. You can leg into a buy right strategy. There's nothing wrong with that. The difference in the distinction between just a straight out of the box covered call and a buy right strategy is generally that the buy right strategy entails one specific movement. It's not necessarily the intent of a buy right strategy to own the stock and sell calls on an ongoing basis to generate premium. It is much more of a directional type of strategy. So it is akin to something like a long vertical spread, specifically a long call vertical spread, or a long diagonal spread, a long call diagonal spread. So the word right simply refers to selling the contract or creating the contract. So when we sell the contract, we're writing that contract and establishing that obligation. So that's why it gets the name that it has, and that's why it's maybe a little bit different. So early assignment could happen. If it does, that was the intended goal of the trade. So I think maybe from a psychological standpoint, JDML, that maybe there's a distinction made between a regular covered call and a buy right strategy is to take away some of this fear of assignment and having the stock called away. If that is your intent at the outset of the trade and that happens, then that's okay, because that's what you wanted to have happen. As opposed to a covered call trade where somebody buys a stock, price of the stock goes up, and now that covered call is in the money, and they are reluctant to do something with the trade because they don't want to lose the underlying stock. So that maybe is the difference. Because you remember when we learned about trading covered calls last week, we talked about asking a question. And the question that we asked was, am I really, truly, honestly willing to sell these shares of the stock? Because that can and it potentially could happen in a covered call strategy. The shares could be called away. In this particular case, in creating this buy right strategy, the answer to that question is most emphatically, yeah, I am okay selling those shares. In fact, that is exactly what I want to have happen. So that's kind of the structure of this trade. And additionally, it may be one that is better suited for higher implied volatility scenarios or higher implied volatility for an individual stock. Because remember, implied volatility brings the potential for movement in this discussion. So let's kind of walk through this really quickly. The max gain is going to be the price of the stock all the way to the strike price plus the premium that we bring in. So wherever we buy the stock to the strike price, that's going to be part of our max gain in the trade plus the premium that we receive that's also going to be called in that. So we might call that if called out gain, right? The gain or loss on the stock plus the premium that we bring in. Max loss, on the other hand, if the stock were to fall to zero, the risk is in owning the stock. We talked a little bit about that. The break-even point is the original stock purchase price minus the premium. That puts us at that break-even point. So for some traders, bringing in a premium to reduce that break-even point gives a little bit of downside protection. So in the event that we're looking at a price move to the upside, but that move doesn't materialize right away, or maybe it doesn't materialize at all, having sold the call option, bringing in a little bit of that premium buffers a little bit of that downside. But the risk is still there unless the underlying stock is sold to eliminate that risk of the stock going to zero. So that's something to pay attention to in this strategy as well. So what are some stocks that might be good candidates, or what are some characteristic stocks that might be good candidates for a buy right strategy? Stocks that appear to be in a neutral but maybe breaking out trend. Maybe stocks that are approaching or have a resistance level overhead. So one way to maybe think about this is if there is a stock that's been moving sideways, or it's been moving in a channel, or there's a price pattern that defines an overhead level of resistance, and the intent is to trade it like a swing trade. And by the way, Michael Fairborn, who's out there in the chat, teaches a great class on trading, on swing trading. And I think that's later today, isn't it, Mike? I'll let you put the link out there. But that focus on trading from a level of support to a level of resistance. And since we're talking about trading calls, we're going to look at this in that bullish direction. So trading from a support level to a level of resistance, or from a level of resistance breaking out to the next level of resistance. That's very similar to this buy right approach, where we might have a resistance level overhead and we're willing to sell a call option at that point to give us an exit from that scenario, right? So breaking out of a resistance level or bouncing up from a level of support may be one way that traders would use a buy right strategy covered call. So obviously we want to have liquid stocks, we want to have liquid options. So fairly narrow or tight bid ask spreads are also a consideration. So some of the other considerations, we may look at selling just at the money, depending on where the premium is and what the expectation is. Some more aggressive covered call or buy right strategy traders may sell at that at the money position simply to be able to buy the stock at a little bit of premium and then sell it when it gets right back up to where, when the price of the stock gets to where that strike price is. Some traders will go out of the money, but maybe not as far out of the money as they would go if they were just doing a covered call where the intent was to keep the stock. Buy right strategy traders tend to be perhaps a little bit on the shorter end of the expiration cycle perspective, simply because the intent is to be called out of the trade and bring in that premium and then maybe turn around and do it again. So that's a consideration as well. And then position size, of course, you've got to be able to buy the 100 shares of stock in order to sell the covered call against that 100 shares of stock. So let's jump into the next part of this, just those potential exit signals. When you think about it, one of the primary ways to exit a buy right strategy covered call is to let the shares get called away, let the shares get sold, and then turn around and do it again. And that'll lead us into our next strategy next week of cash secured puts, and we'll talk about that. But if, in fact, the price of the stock starts to move down, that is a means to maybe, or a circumstance where a trader might want to look at exiting the underlying stock. But it's important to remember to buy the call option back first to eliminate that obligation, so you're not left with an inadvertent naked call option. All right, so a couple of questions, and I'm going to answer a couple of the questions in this discussion, hopefully, as we get into this discussion. So is it good for volatile stocks, or reduces your cost per share if it doesn't sell? Yeah, volatile stocks bring in a little bit more premium, but volatile stocks also have movement, and movement goes both up and down. So you think about it, if your intent is to have the stock called away, you buy the stock, sell the call option, and expect that it's going to be called away, maybe that little bit more movement isn't such a bad thing. You want some directionality to this trade. But remember, if it cuts to the downside, this isn't a set it and forget it. Your intent isn't to roll it, although you could roll it, and some traders do roll the short call option to a next month and do it again. But more often than not, buy right strategy traders are looking for one move. All right, they're looking to get into the trade, buy the stock, sell the call option, and then let that stock get called away, or exit the position by buying back the call option and selling the stock, is generally the way they approach it. Now, Mickey asks a great question, and this is an interesting question. What about selling an in-the-money option with a long-distance leap as a basis just to collect extrinsic value? Yeah, that's kind of a compelling thought. And you are, Mickey, I wish I could tell you you're for the first person to think about that, but unfortunately you're not. The problem is what you're doing when you sell an in-the-money option is you're selling your own intrinsic value, essentially. Because if you're selling an option that is in the money, it has intrinsic value. You sell an in the money strike price. Not only are you selling extrinsic value, yes, you're selling a fair amount of extrinsic value because it's a leaps option further out in time, but you're also selling your own intrinsic value. So if the price of the stock goes down, well, now you've already sold off some of that value. Now, I get the idea because you buy the long dated leaps option instead of the underlying stock, that becomes a challenge, right? But it is a substitute. So we'll talk about that as we get into long vertical spreads, because this becomes a little bit like I said, a long call vertical spread or a long call diagonal spread. So that would be a way to do that. And sometimes that's referred to as a poor man's covered call. Yeah, I noticed that. Thank you, Arun. I noticed that is exactly the same. Yeah, thank you. All right, let's do this. Let's pop over to the Thinkorswim platform and let's take a look at an example. This is an example that I've been watching for a while. I talked a little bit about this area of the market this morning in my Trading Futures webcast as copper started to move. And Freeport-McMoRan, one of the major copper producers here in the United States, been watching this for a while. Now, I do happen to have shares of this particular stock in my portfolio, in my demonstration portfolio. Again, not a recommendation, but we're going to trade this from the standpoint of a buy right covered call strategy. So we're going to buy the stock and we're going to sell the covered call at the same time. And I'm going to come over here on the right-hand side. I'm going to kind of zoom in on this so that we can see it. So stocks kind of been moving in this channel from about the 58 mark to about 70. So what I'm going to do is I'm going to just draw this line right here. And we're just going to build this as a kind of out of the box, buy right type of covered call strategy. So what I'm going to do is I'm going to take that distance of that channel that this has been in, and I'm going to put it up here on top. And so I'm going to go up here to about the $82 mark, right? That's just a symmetrical distance to the upside. So what I want to think through is what this would be like if we were trading this as a swing trade. So I'm just above that resistance level. That now becomes a new level of support. So the distance that I'm looking at trading the underlying stock, if I were holding the underlying stock, would be from here up to here, right? That's what I'm looking at. There's my target for this trade, is up around $82. Okay. So it's currently sitting at, we'll call it 70 to 82. I'm just going to use that easy math. We're just gonna ballpark this. So $70 to $82 is $12 gain, right? So this is about a $12 gain in the price of the stock. So cool. If I were to swing trade it and put a limit order up there at that target right there at $80 or $82, wherever, I could get into the trade now. I could get out of the trade if it goes to that distance. But I'm not getting paid anything to put that limit order out there. So if I just created the order like this to buy the stock, right? If we were going to buy the stock like this, so we're going to right click and then we're going to buy custom with, say for instance, an OCO bracket. Now, that would be putting a stop on here. I'm only going to do part of this right now. But if I were to put a target up here at about $82, right? 82. So that distance from 70 to 82, where I would get into the trade to that 82, that is my target gain in the trade. But I'm not getting paid anything to have this limit order just sitting there waiting. So it's just it's they're working for me potentially, but it's kind of a lazy employee, if you will, because it's not paying me any benefits to be there. It's hopefully going to work when the price goes up, if the price goes up, but it's there to do something and it's just hanging out to do it. But if we were to create this as a buy right strategy, right, and we were to look at buying the underlying stock and also selling an option somewhere up around that range, then we're looking at a different perspective, slightly different perspective. So let's go to the trade tab. A couple of other things that I want to put on here. I want to look at implied volatility. So I'm going to put implied volatility down here in the bottom panel so that we can see this. Implied volatility is relatively high. It's not the highest it's been. We're post an earnings announcement. So implied volatility is likely to either stay high or fall. But you know what? Remember we talked last week about the idea of selling a covered call, just a straight out of the box covered call, and being able to buy that call option back cheaper than what we were paid for it to begin with so that we could then sell another one. And one of the things that benefited us in that case was high and falling implied volatility. In this particular case, since our intent is not necessarily to buy back the call option, but rather to have that call option exercised, have that call option in fact end up at or in the money, I'm not really all that worried about implied volatility falling. What I'm worried about is implied volatility being high enough that it gives me enough juice for the squeeze in this particular trade. So if I don't have a circumstance where implied volatility is high and falling, but I have a circumstance where implied volatility is high and maybe staying high, then that works nicely for a buy right strategy covered call. So we're going to go over here to the trade tab really quick. And I'm going to say, all right, look, the price of the stock has been moving higher. In fact, the last couple of times that it's made that move from the bottom of the channel to the top of the channel, bottom of the channel to the top of the channel, bottom of the channel to the top of the channel, it's taken about 2 or 3 weeks to do that. So I'm going to go back to the trade tab and I'm going to say, look, I want to give it 2 weeks plus maybe another couple of weeks. So I'm actually going to go out here to maybe the 2 July expiration, maybe even a little bit tighter here. I'm going to go at maybe even a little bit more, or excuse me, a little bit tighter. I'm maybe going to go to the, you know what? I'm okay with the 2 July because it's got a little bit higher implied volatility. So one other thing that I want to pay attention to is this. I'm going to come over here to the right-hand side. So here's my 2 July expiration, the one I'm going to be looking at. And I'm going to come over here and I'm looking at that expected move based on that current level of implied volatility. So based on that current level of implied volatility, the expected move up or down is about $10. So we want this to move out to about $12. So what I might do in challenging that, in thinking about that 2 July expiration, and this is where there's always a compromise, right? Because having it go out that far is probably a little less likely between now and the 2nd of July. But I have the opportunity that if it does make that move quickly, that I could do it again more frequently and buy the stock and then sell the covered call. But if we're just going by expected move, and I'm expecting this to make about a $12 move to the upside, that might put me in mind of going out here to the 17 July expiration because the expected move is about $12, right? Based on the current level of implied volatility. And remember, implied volatility is very high at the moment. Not that these are guarantees of how far the stock is going to go, right? But those are what the market, what the options market is expecting that the price of the stock is going to do. So I'm actually going to go in just for this example, we're going to go out to that. We'll go out now to the 17 July expiration. And we're going to go out. I have an 80 strike and I have an 85 strike. So 85 is a little bit outside that range, but I'm okay with that. 85 is okay with that. We might go to the 80 strike. I'm bringing in a little bit more premium. So the 80 strike inside my target, inside the expected move, and it's bringing in a little bit more premium. So I'm going to look at selling the 80 strike option. And that gives me perhaps a little bit greater probability that the price of the stock is going to get to that target and put me in a position to have the stock called away from me. Now, that's what my current single option is trading for. $2.78 is the amount of premium that we're looking at bringing in. But I'm going to make one quick change here on the display in the option chain. And I'm going to go right here and change this spread from single to covered stock. And whenever you look at covered stock on the Thinkorswim platform, that is, you can read that as covered call. So I'm going to come down here to the 80 strike. And on the call side, that 80 strike is trading for $68.38. Now, you notice the stock's currently trading for $71. What that $68.42 is the net cost of buying the underlying stock and selling the 80 strike at its current level of premium. So $68.40 is essentially the effective cost that I'm buying this stock at. So $68.45, let's just run the numbers here. $68.45 plus, or excuse me, let's do this. 80, which is our short strike, minus 68.45, $11.55. So we're getting paid a little bit to do that, to take that trade. What we might then think about doing is $11.55, a little bit less than we would make if we bought the stock. Well, actually now, if we bought the stock at 71, we're looking at about a $10 move out to that 82 mark or to that 80 mark. So a little bit inside that. So selling doing the buy right covered call actually gives us a little bit better perspective on this trade. We're bringing in a little bit of premium in exchange for that opportunity to take advantage of that upside movement in the price of the stock. If we were to go out to the 85 strike, 85 is the price at which we would sell the stock minus 69.43, 69.43 gives us a little bit bigger gain, but a lower probability of getting that gain, if that makes sense. So I'm going to go with the 80 strike. We're going to look at selling the 80 strike, actually buying this 80 strike covered call position because we've got to buy the underlying stock. So I'm going to left click on the 80 strike ask price, and it's going to bring up an order. This is a buy right covered call. So we're buying the underlying stock and selling the 80 strike call option for a net debit of $68.35. That's the net debit for this trade, which means I'm now going to be long 100 shares of the stock and short one contract of that July 17th call option. So I'm going to click on confirm and send. I'm going to send this to my cash secured puts and covered calls group. And so you can see what my net cost is on the trade. And that is my max theoretical loss in the trade, assuming that the price of the stock were to go all the way to zero in this particular case. So I'm going to go ahead and I'm going to click on send, and we're going to fire that order off. We bought it. Now we've got that call option in place and that obligation to deliver the shares at $80 a share. So this buy right strategy covered call strategy is very similar to, like we said, a swing trade, a short to intermediate term swing trade. We're just getting paid to have that limit order out there to take that trade off. And we're using this. Now, would you have to put a stop in a separate order? So let's do that on this next one, Rita. And let's see how we would accomplish that. Because the risk in putting a stop on this is that we end up with an inadvertent naked call option position. So you've got to be able to close the call option first, buying it back, and then sell the underlying stock. So I wanted to answer C Money's question here. how did you add the today's option statistics tab to the bottom? That is there at the bottom of everybody's or of every option chain. You just have to click on the little drop down arrow to open that up, and that's going to tell you things like where implied volatility percentile is, where that current level of implied volatility is, sizzle index information, and other pieces of information. So that's down there at the bottom of the option chain. So a couple of other examples that I wanted to look at here. This is another one kind of sort of in that energy space complex. So let's take a look over here at OXY. I talked a little bit about this yesterday when I was talking about trading with technical indicators. Some of you were in that webcast with me on trading with technical indicators. And one of the things that I was looking at doing was getting into the trade when it made a move to the upside and then targeting where I was going to get out up here around that 67 mark, right? So yeah, you absolutely could do a lower price stock. There's nothing wrong with that. What you then realize is the lower the dollar value of the stock, the less premium that you're going to collect. So let's do this one and let's take a look at a lower value stock. So I have on here right now a buy stop limit, right? And that buy stop limit is to get into this trade when the price of the stock breaks that resistance level. So I'm kind of sitting here waiting for that circumstance. And I'm not really willing to buy the stock at this point because I don't have a confirmation that the price of the stock is going to go up. But I'm going to cancel that order. And I'll show you how I'm going to put this together. Is my expectation is that the price of the stock is going to go higher. And just kind of zoom over here to the right-hand side. And maybe it runs out to this resistance level out here at 63. Maybe it runs up to 67. But the fact that I'm waiting for that breakout of that resistance level to get in because I don't want that circumstance where it's going to pull back to put me in a losing position right away is another use case for a buy right strategy covered call because I'm bringing in a little bit of premium that's kind of serving to offset that wait for the price of the stock to move higher. So let's see if we can do this. I'm going to get into the stock right now, and I'm going to put a covered call on here. I'm going to sell a covered call with that expectation that the price of the stock is going to go higher, but it's going to maybe give me a little bit easier time justifying getting into the trade right here where it hasn't broken through this resistance level. Because then if it doesn't break through this resistance level, I've at least collected a little bit of premium, and then I could turn around and sell that premium again, and I own the underlying stock. So let's do this. Come over here to the trade tab, and we're going to take a look at Occidental Peat. And again, timing matters here. So I'm going to look and see where that next level of resistance is. It's out there about 67. I'm actually going to detune that a little bit back to about the 65 mark or so. So I'm going to say from 60 to 65, that's the move that I want to get. But I'm about a point below that, so that's going to be about 11 points to the upside. So I'm going to look out here once again, maybe out to about 80 days to go, or maybe even a little bit shorter than that. Let's go 45 days to go here. And I'm going to take, back to single so that I can see how much premium I'm bringing in. So I'm looking at selling the 65 strike price here, call option, bringing in about $1.26. Implied volatility is relatively high, bringing in a fair amount of premium here for 2 strikes out of the money, $65 a share stock, but not a huge amount. But it's enough to offset that wait for the price of the stock to get from where it is right now at 59 to that breakout point that I had that was a little bit above 61 or a little bit above the 60 mark. So I'm going to create this as a buy right covered call. I'm going to come back here, change this to covered stock, and we're going to look at getting into the 65 strike, which is where our stock is going to get sold if the price of the stock goes up. And I'm fine with that. But I'm going to be able to buy this stock for $58 net debit, $58.09 net debit, with the intent to get out of the trade at 65. So once again, we can look at what that return is. So we'll come back here to the 65, 58.08. So 65 minus 58.08 equals $6.92. Divided by the amount that we're paying for the option, or for the trade, which is 58.09, 58.09 9, and that's about 11% or I'm sorry, a little bit better than 1% return on risk if we are called out. So that's okay. Actually, it's 11%, right? All right. So now, as we do this, let's put this trade together. Let's come back over here and left click. Here's our buy the stock at 50, well, net debit of 5807 and look to sell it at 65. So I'm going to click on confirm and send. We're going to read through the order, make sure that that's what we want it to do. And we're going to click on send. And now there's that entry. Okay, last example we're going to do here really quick. And I promised Rita we're going to put a stop on this one. So I'm going to go back over here, and I think we were looking at GLW. And I think this is a little bit lower price stock. GLW. It is not. It's a little bit higher price stock. I'll come back and we'll do a little bit lower price stock. But my intent is, and this is another scenario, bullish uptrending stock, implied volatility is high. It's running up towards this resistance level. Premiums are probably pretty juicy. I want to get called out if this goes up to say let's call it 215 up here at that top side. So we're going to go back to the trade tab. And this is going to be relatively fast. So we're at 199. And so I want to see about a 15-point move. I could even do this. I'm going to do this in 10 days. I'm going to go a little bit shorter term here, but we're going to put a stop loss on this one as well. So let's do this. Let's make this a single order again. And we're going to look at the strike prices here. I've got a bunch of strike prices on this one. We're going to look out at about, we said our resistance level is up here at about 215. Where's our 215 strike? There's our 215 strike, and we're bringing in a fair amount of premium here. So decent, pretty juicy premium here at that 215 strike. What we're going to do is we're going to change that layout to covered stock. There's our 215 strike. We're inside the expected move here. And so we're going to be buying the stock essentially at a net debit of 193.97. So what I'm going to do is I'm going to left click on that ask price, and we're going to create this order. So buying the stock at 193.58. Now, before we place this order, I'm going to come back over here and I'm going to say, where do I want to get out of this trade? I want to get out of this trade if it moves below, for instance, this 177 mark. So that's going to be my threshold for this exit in terms of putting a stop here. We're going to put that stop order right about 170. I'm going to call it 177.93. So we're going to go back to the trade tab. And we're going to bring up our order. And I'm going to change this from single order to first triggers sequential. And I'm going to right click and I'm going to create an opposite order. So the order of operations here is important, right? Because we want to be able to close the trade down by buying back the call option and eliminating the stock and selling the stock. The most important part of that is eliminating the call option so we're not left with an inadvertent naked short position. So I don't know exactly what that credit is going to be because I don't know what the option is going to be trading at that point. So what I'm going to do is I'm going to make that a market order for the option, for that spread between those two, because I'm not really worried about what that spread is between those two, the short call and the long stock. But what I want to do is I want to trigger this order based on a condition. And that condition, we're going to make this good till canceled. That condition here is GLW marking at or below, we said 177.93. So if the price of the stock goes below that level, now close me out of this trade by buying back the call option first and then selling the underlying stock. And that's what this is intended to do. So we're going to go ahead and click on save. Now we've got that stop order in place. But if you were just going to put this on and build it yourself, or put a stop order on here, or do something to manage this trade, manage the short call first. Manage the short call first. So we're going to go ahead and click on confirm and send. Read through this order, make sure that this is what we want to do. And we're going to put this in our cash secured puts, covered calls group. Click on send and fire that order off. And now we're in the stock. Now we're looking for that. Right, there you go. So now we've got that stop order in place. So the delta on the single, so Barbara says delta is only 33 delta. Why wouldn't you choose a strike with a higher delta, get more premium if you don't care if you lose the underlying stock? Because we want to give it enough room to move to the direction that we think it's going to move. So this is where there's always a trade-off. You're absolutely right. You could choose, if you look at the single leg, we're at a 32-cent delta, you could bring in a little bit more premium if you went closer. If you went closer to the at-the-money strike, but you're not going to get as much on the upward movement in the price of the stock. So it's always a trade-off, right? How far do I think the stock's going to go, Barbara, versus how much premium I'm bringing in? And there's no one right answer here. It's just a matter of, that's where that expected move can be a very helpful tool, as can be levels of support and resistance by doing the technical analysis. So we've done a couple of different examples of buy right covered calls. Now, the way that we manage these trades is simply let them get called out or close them down or roll them if we get to expiration of that option or close to expiration of that option and it expires worthless, we'd maybe sell another one and keep the underlying stock. But in rare occasions would a buy right strategy turn into a longer term trend trade. The intent, again, is to buy the stock, sell the stock when it gets to that target. It is a shorter term to intermediate term type of strategy selection. So I want to give you a couple of resources. We're going to pop back over here to the Trader Talks webcast page. If you click on Getting Started with Options, you're going to see all of those Getting Started with Options webcasts. But if you come back over here and we type in, let's just type in the word buy right. Now you've got Barb Armstrong, an example trading plan, buy right covered calls. She's done a mini session on that. She's done a buy right covered calls as an income generating strategy. Brent Moore is talking about the basics of a buy right covered call. And Connie, as Mike pointed out, Connie teaches a long calls and diagonals webcast where she equates a buy right covered call strategy to a long call diagonal spread. When you get here, just click on that subscribe button if you haven't done so already. Give us a like if you enjoyed this webcast. Again, if you want to see our full schedule of upcoming webcasts, come right here to schwab.com/coaching. Go to the live webcasts and virtual workshop schedule. You can follow me on X. You can follow Mike on X at Ben Watson CS, at Mike Fairborn CS. Look forward to seeing you all there. Guys, have a great day, and we will see you again very soon. Take care, everybody. Bye-bye.